The CPI, Consumer Price Index, doesn't include tax. The largest single living expense for most American households is tax. Now, you know me well enough to know, Andy, if I didn't have to pay the tax, I probably wouldn't bitch quite so much about the index. But that's not on offer. And it's important for your listeners to recognize, on the one hand, $130 trillion in liabilities, which is to say the credit quality of the debtor is not as good as you might believe. And at the same time, to realize that real interest rates are decidedly negative.
This is Little by Little with Andy Schectman.
All right, everybody, welcome back to another episode of Little by Little. Today's guest truly needs no introduction to the world of natural resources and contrarian investing. And on a personal note, after 35 years in this industry, I can honestly say that no one has had a greater impact on my career for a myriad of reasons than Rick Rule. I hope you know how much that means to me, Rick. I truly do. And I'm really thrilled that you're here today. Welcome in. And how you doing?
Well, as the kids say, right back at you. We, for many years, had a relationship with your company. And I'm delighted to say, in probably 20 years of running a retail brokerage firm, we didn't have one single customer complaint about Miles Franklin. There are other bullion dealers who we had experience with.
Well, you know, and to this day, some of the brokers, Eric and Kenton and Mishka and Anthony, are some of my best buddies in this industry. And working with you and your people has been a really game-changing experience for me. And I can't thank you enough for the trust you've had in me all these years and the friendship. And I'm grateful that you're here today. So let's jump right into it. And, you know, I watch a lot of your stuff. I try to catch as much, and you're prolific. I've always said you're the hardest working guy at any of the shows I go to. You're the first one there, you're the last one to leave. And that's carried over into your interviewing. So I try to catch most of what you do. I've never heard anyone ask you this. And I ask it to you because last time I saw you in Vancouver, I figured, I'm walking out of the elevator with Jay Martin in Vancouver, and I figured no one's even awake yet. There you are sitting by the fire reading whatever you're reading, and you look like you'd been there for an hour. Yeah, always the first one there. And you mentioned something about, I told you I was going skiing in Whistler, and I used to be a logger up there. So let's rewind the tape for a minute. I've never heard anyone ask you, what was the young Rick Rule like? I'm talking about the guy that was working as a logger on Blackcomb Mountain.
I was a pretty hard worker. I emigrated from the United States to Canada if my memory serves me well, 1970. I went to the University of British Columbia because they had the only degree program in North America focused on natural resource finance. My parents disagreed with that decision, and one consequence of that is that I had to finance my own education, which meant I had to hustle for any kind of job I could get. I worked on tugboats, I worked up in the Arctic on a dredge, I worked setting chokers logging, I was a bouncer. With my pickup truck, I cleared junk and gardens and stuff on weekends. You know, I kind of hustled and did it all. I'm delighted I'm not in that position anymore, and I am very grateful that I did all those things. I had really a wonderful time as a young man. I met a lot of great people. Everybody should come up hard scrabble, I think.
I agree. I totally agree. Teaches you a lot of valuable life lessons, and I admire that about you. And that's really why I wanted to ask you. I kind of knew some of that stuff, but I wanted everyone else to know that, nothing came easy. Nothing good ever does come easy. Along the way, Rick, you lived through more market cycles than most investors ever will. And I've heard you talk about this a little before, but something that I'm curious on, does today's environment feel like deja vu, or are we in uncharted waters in your estimation on multiple levels?
I think some of both. On the face of it, what we're heading into reminds me a lot of the decade of the 1970s. I think that the gradual devaluation in the purchasing power of the U.S. dollar is an inevitability, and I think it's begun. That's very similar to the 1970s. The Office of Management and Budget said in the 1970s, the U.S. dollar lost 75% of its purchasing power, not against other currencies, but over that decade, what would have cost you $250 in 1970 would have cost you $1,000 in 1980. And I think we're coming into that. I think there are two other factors that investors need to consider when they think about that. One is good and one is bad. The good one is that we have enormously better technology now. Enormously better technology. And human advancement and advances in efficiency will be driven as much by technology as capital. The market that we saw in 1970 was very, very different. Advancement was very, very capital intensive, much, much, much less technology intensive. And even in the United States, or perhaps I should say particularly in the United States, despite some bad aspects of our culture, we still are a place where 6 kids can take over a garage in Sunnyvale and out pops Google or out pops Apple, making billionaires, but also making life more efficient for lots of people. So that's a very, very good thing. A very good thing. I'm tempted to say that for the last 40 years, our individual ingenuity and tenacity has funded our collective stupidity. Now let's move on to that collective stupidity. At the beginning of the decade of the 1970s, the unfunded entitlement liabilities, the off-balance sheet liabilities of the U.S. government, were effectively zero. We had a very young demographic. The baby boomers, you and I, were just coming of age. So there was a lot of employed workers looking after a very few beneficiaries. Today, the net present value of unfunded liabilities, according to the Congressional Budget Office, not some old crank named Rick Rule, is $100 trillion. That's a very different number. To put it in perspective, gross federal revenues before any expenditure is $5 trillion. And the net present value, not the nominal value, the net present value of unfunded entitlement liabilities is $100 trillion. In 1970, as we were entering into this epoch of devaluation, on-balance sheet liabilities of the federal government were between 25 and 30% of GDP. Now, on-balance sheet liabilities, which is to say the money that we owe the bondholders, exceeds 120% of GDP. So if we have a circumstance where the challenges are similar, and I think that's where we are, the difficulty that we have is that we have already stretched the rope much thinner than we did in the decade of the 1970s. Make no mistake, Andy, you know and I know that we're going to get through this. But it's going to be a lot harder than it was in the period 1982 to 2022. That 40-year epoch where the dollar reigned supreme, where we could export inflation to our, quote, allies, where real and nominal interest rates were falling, where the wind was at our back, that's over. And we're coming into times that are much more challenging times. I hope all of your listeners, but especially your young listeners, understand that the time where the wind was truly at your back and the time when you could plan your future based on Medicare, Medicaid, Social Security, all that kind of stuff, that's over. You got to rely on yourself. And that would be my most important answer to that question.
And a good one. And I think people don't quite understand when we say $100 trillion, just how big that is. A trillion seconds ago was 31,688 years ago. Multiply that times 100. It's a big number. In fact, I wonder why they never talk about it when they mention the indebtedness of the country.
Here's a good way to quantify it. The Internal Revenue Service, whose business it is to know this stuff, suggests that the private net worth, the aggregate private wealth of all Americans, is $141 trillion. The sum of the net on-balance sheet indebtedness, that is net of the Fed's own treasury, is about $30 trillion, and the off-balance sheet liabilities is $100 trillion. So we're 141, and we owe 130. That'll tell you how big that $100 trillion number is.
Doesn't sound like that great of a balance sheet, if you ask me. And along those same lines, Rick, traditionally the 10-year Treasury has been the go-to flight to safety. Yet here we are with rates back up at 4.5%. And what's interesting and not really talked about, it was very quiet. This group called SOMA, a branch of the Fed, they come in and quietly lift up the markets, I guess. They just bought $34.8 billion worth of 3- and 10-year Treasuries last week. Is the Fed losing control, and what are the broader implications of that?
I think the government does do their best to control credit markets. It's interesting to me that the Fed and the executive are doing all they can to bring interest rates down. They've been pretty successful on the short end of the trade. And I need to say, I own 2-year Treasuries. I'm maintaining a lot of liquidity, and I want to make sure I get paid. So I own some Treasuries. But it's interesting to watch them lose control of the long end of the curve. And I think despite their best efforts through at things like moral suasion and direct on-market operations, that they are losing control of the long end of the curve, and they're losing it to the market. Andy, it's great that you mentioned the 10-year Treasury, and you and I have had this discussion. If you believe that the CPI is an accurate measure of inflation, then the yield on the 10-year Treasury represents adequate real return to investors. Make no mistake, they will pay you because they can print it. If you were receiving 4.5% against a currency that was devaluing at 2.5%, you get a 2% real yield, which riskless is not a bad thing. I dispute that CPI number. I'm no economist, but I do keep track of my expenditures. I'm an old fat cheapskate, And when I look at the basket of goods and services that I consume, I think that the deterioration of the purchasing power of my savings is at more like 7.5%. John Williams from Shadow Stats would tell you 12%. But I think it's more like 7.5%. So the value proposition around the U.S. 10-year Treasury for me is that they pay me 4.5 in a currency that's devaluing at 7.5, meaning they cost me 3% of my wealth a year every year for 10 years. Risk-free return, as Jim Grant would say. The other interesting thing about the CPI, and sort of harp on this, but people need to get it. The CPI, Consumer Price Index, doesn't include tax. The largest single living expense for most American households is tax. Now, you know me well enough to know, Andy, if I didn't have to pay the tax, I probably wouldn't bitch quite so much about the index. But that's not on offer. And it's important for your listeners to recognize, on the one hand, $130 trillion in liabilities, which is to say the credit quality of the debtor is not as good as you might believe. And at the same time, to realize that real interest rates are decidedly negative. I just, by the way, gave your listeners the gold thesis.
Well, yeah, and you're the only, I heard you say this last year. You're the only person I've ever heard say something so illuminating. The light bulb went off that you're right. The single biggest expenditure of every working American is tax, and yet that's not included in the CPI. It's interesting. Something so commonsensical would just, of course, be omitted. And I think that's something people should take into account. And everyone should go to shadowstats.com just to see Mr. Williams' measurement of not only the CPI, but also of employment numbers are free, and they are worth checking it out. Of course, you can subscribe to his service and get his further analytical viewpoints on things. But Yeah, I think right now he would say add an 8 to the number that the Federal Reserve or the government is, the Bureau of Labor Statistics rather, is telling us, add an 8 to it, and that's probably a closer estimate to where we are, to your point, over 12%. Here's a question I've never asked you, but I'd love to know your take on it, and that would be, why does, well, and you just mentioned, you kind of gave the thesis, so you kind of answered the question, but why does Rick Rule personally own gold? And most gold bugs, would rather cut off their pinky than sell their gold. Is there anything at all that would ever make you sell your gold?
Yeah, I've sold my gold on occasion, not all of it. I've always kept some. But to me, gold is a few things. It's insurance. It's liquidity, because I am willing to sell it if something better comes along. And it's interesting, you asked the question, what would make me sell gold? I was addressing my own audience at the Rule Classroom a couple weeks ago. And I told people that I expect the decade coming up to resemble, in some senses, the decade of the 1970s. I expect that the purchasing power of the US dollar will decline by about 75% over 10 years, which is what happened in the 1970s. And I think that the rise of gold will more or less maintain your real purchasing power in US dollars. If that happens, it makes absolute sense that if the purchasing power of the US dollar over 10 years declines by 75%, that the price of gold will increase threefold or fourfold. In the decade of the 1970s, with the purchasing power of the US dollar declining by 75%, the gold price ran 30-fold. Now, important to understand that probably the move from $35 to $100 between 1970 and 1973 had to do with removal of the price cap and allowing people to buy gold, because the London price of gold was higher than the US price of gold. And I would argue that the move from 500 to 850 was reversion past mean, which is to say investors were piling on to gold. But that move from $100 to $500 is, I suspect, all a function of the deterioration of the purchasing power of the US dollar. It's past its prologue, and it won't be exact. My suspicion is that my purchasing power will decline by 75%, and the gold price will keep me whole in nominal terms. What would cause me to sell gold? Now I'll answer your question just for fun, Andy. If the reasons to own gold went away, specifically, if we saw a balanced U.S. budget. A balanced budget in real terms, not where the savings come in the out years and the expenditures occur this year. So I'd have to see a balanced U.S. budget. I would also have to see a fiscally responsible, politically acceptable solution to entitlements. I would have to understand how we funded $100 trillion in net present value of entitlement liabilities. I would also have to see, by the way, I'd settled for 2 out of 3. I would also have to see positive real interest rates. In other words, I would have to see the yield on the 10-year Treasury exceed by 150 or 200 basis points the underlying rate of deterioration of the US dollar, which is to say, rather than seeing a US 10-year Treasury at 4.5, currently I'd have to see a US 10-year Treasury at 9. And just for fun, I think it's also worthy to note that the market share of precious metals and precious metals related investment products is about 0.5% right now, which is to say, if you look at the total value of savings and investment assets in the United States market, the market share of precious metals and precious metals related securities is about 0.5%. The 4-decade mean, according to JP Morgan Chase, is 2%. So I would probably also, before I sold gold, have to see the market share of precious metals relative to other savings and investment assets in the United States revert to mean. Those 4 things would cause me to sell gold. The only other thing that would cause me to sell gold would be such a dramatic undervaluation in some asset class that I understood that I could see some other place to maintain my purchasing power that exceeded gold's ability to do so, and do so simply.
So in other words, you're never going to sell your gold.
I'll leave that to the imagination of your listeners.
Yeah, no, and what would 9 or 10% interest rates do to this economy? So many of these things that you say are so eloquent and so logical, yet you can imagine what the world would look like in that environment. Let's shift a little bit to your bailiwick, and that is the mining shares. And gold's broken above 3,000. Oil is relatively cheap, and yet the mining shares have lagged badly in general. Not all of them, but the gold mining shares in particular. And
Yep.
Given the compression and the all-in sustaining cost, which would you put all the costs of oil and labor and all the things seem to be low right now relatively. Are we staring at one of the best value setups in precious metals equities ever? And secondly, and please feel free to talk about this if you'd like. I know that you've always talked about, you've reviewed thousands of portfolios over the years. You offer that service now, I think, on the Rural Investment Media website. What are some of the most common and costly mistakes you've seen investors make? So in other words, is this a great value? And what are the mistakes people should avoid, the common mistakes that you've seen over the years?
Let's start with a statement that answers part of both questions. Probably 90% of the mining company shares listed worldwide are valueless. So when you talk about gold mining equities, all of the value is in 10% of the listings. If there are 3,000 companies worldwide that are nominally public and nominally in the mining business, probably 300 of them, 10% of the total number, are worth considering. So don't consider the sector as an asset class, because as an asset class, it's an absolute disaster. If you aren't willing to do the work to separate the wheat from the chaff, just buy physical gold and relax. I'm sure that is music to your ears, Andy. If you are willing to do the work, however, the sector is on fundamentals, on enterprise value versus net present value, as cheap as I've ever seen it. And importantly, the bull market is already underway. This will be my fourth bull market. The first one was in the decade of the 70s when I was too young and dumb to understand the first half of it. But the next two, I played reasonably well. And bull markets follow a very predictable pattern. It's led by the commodity, which almost always is revaluing from an oversold base, which gold certainly did. As I say, the market is led by the commodity before the equities. And this time that happened in spades, because market leadership wasn't from retail people, but rather from central banks. And central banks don't buy gold shares. So gold went up without the gold shares responding, because there was a buyer for one asset class and there wasn't for another asset class. Traditionally, in precious metals bull markets, after the metal leads, two good things happen from an investment perspective. One, the increase in the metal price occurs faster than the costs associated with producing it. So the margins increase. At the beginning of this bull market in 2023, we didn't see that, because input inflation, particularly energy, but also skilled labor, and most particularly social rents, taxes, and royalties, increased faster than the gold price. So although the gold price went up, the producer margins didn't go up, and in some cases declined. That hurt investors' feelings, my own included. But that turned around last year. The increase in the gold price continued, while the input costs around skilled labor and energy in particular, but also fabricated products, steel, cement, declined. And the mining industry margins first expanded and then exploded. The money, when it comes into gold equities, comes into the best of the best first. This happens for two reasons. Gold industry investors are risk averse. So although they like the thesis, they don't want to take the risk inherent to the juniors. And when generalist investors comes into the space, they come into the biggest and the best, particularly the passive investors, the ETFs. And we've seen over the last year, the best of the best, the biggest, with share price escalations of 60%, 70%, 100% in some cases. These markets, as I say, follow a predictable pattern. So as the best of the best become more expensive relative to their peers and enjoy a lower cost of capital, that situation resolves itself either through value arbitrage, people like me looking lower in the food chain and seeing things that are relatively cheaper and bidding them up, or it changes because there's takeovers. Big companies take over little companies. But at any rate, after the biggest and the best have moved, the best of the rest moves. After the best of the rest have moved, the bull market comes down into the developers, and after that, into the explorers. Visualize it the way you visualize a circus master's whip. The handle and the front of the whip is the metal itself. It moves first. The biggest and the best are a quarter of the way through the whip. They move after the front of the whip, but they move further and they move faster. Then comes the best of the rest. The middle of the whip comes after the first quarter of the whip, but it moves further and eventually it moves faster. And then finally, the exploration companies, high quality exploration companies, the end of the whip. But remember that bullish statement, and by the way, we're in this equities bull market. You don't have to wait for this one. It's here. Understand that only 10% of the listings worldwide are worth screwing with. So if you aren't willing to do the work to separate in movie parlance the good from the bad from the ugly, buy bullion and relax.
Yeah, this is a reason we'll talk at the end about the Rule Symposium, that one of the two conferences I would never miss. All of the exhibitors there and speakers have been personally vetted by you, and we'll get to that in a moment. You bring something up that I thought about. I've had an account at Sprott, your former company, ever since I knew you back then, and I've always believed in mining shares. And people will ask me from time to time, in the course of doing business, should I own mining shares? I said, absolutely, you should. And one of the questions they often ask me is jurisdictional risk. Generally, it speaks to geopolitical risk. With the election, and I know how you feel about Mr. Carney in Canada, should we be concerned now about, I always said to people, anything in North America is probably a very good place to go. How do you feel about stocks, mining stocks, resource companies in Canada now that they've had this new election? In other words, is political risk something that needs to be factored into the equation?
It absolutely does. By the way, I take a different view of political risk. I understand it. I've experienced it. But the biggest risks in my life have been technical risks, which is to say project failure. I still prefer to have a project that's worth a government stealing than a project that's immune from government theft because it's a lousy project. And so I start with the project before I assess the risk. But I have to say that areas that are perceived to be riskless are often high risk. As an example, the worst monetary effect of political risk in my portfolio ever occurred in 1980 in the People's Republic of California. We made a discovery, unfortunately, 7 miles on the wrong side of the California-Nevada line. And permitting took 13 years and $16 million in bribes, not efficient bribes, but rather campaign contributions, deeds in lieu. You think about the net present value of revenue that's 13 years delayed. That political risk exposed Viceroy shareholders to about $600 million in aggregate losses over 13 years. And people tell me that Congo is risky. In free enterprise jurisdictions, as an example, the province of Alberta, I remember 20 years when the natural gas price went up, and the provincial government retroactively tripled the royalty. Tripled. So I would suggest that particularly investors who look like you and I discount political risk when it occurs in English according to the rule of law by white people. But I've experienced political risks from all sorts of races and religions, and I can tell you that money that's stolen, irrespective of whether it's stolen efficiently in Africa or inefficiently by democratic processes in North America, is just as gone.
How can a government come to you and say, by the way, we're retroactively charging you triple the royalties? How can they do that? Is that even legal?
Yeah. I mean, they make the laws. And remember that you are free to protest online. But if you don't pay, government has a legal monopoly on violence, extortion, and fraud. They have the guns. If you don't pay, you become an inadvertent guest of the state. You and I have both known several people who have experienced this, including Peter Schiff's dad, who was a good friend of mine. And if you resist being kidnapped, you will be killed. I mean, I don't want to sound too stark about this, but
no, it's not stark. And the way that your vernacular is outstanding. The way you say things makes me smile, and you drive a very good point. And I am familiar with Mr. Schiff's being a guest of the state. I'm familiar with that story, and it's interesting when you say it that way. So this is a reason I've often said when trying to explain you to other people that it's not just what you know, and you know so much, it's also who you know. You often talk about partnering or associating with people who are serially successful. And I think in an industry where you say only 10% of the companies are legitimate, not only do you know them all, I'll never forget the first time I saw you at a conference and you were standing in a room full of hundreds of people. You had just got done speaking and people were throwing out tickers, and you would say the name of the company and be able to recite the geological profile of this company. Not only do you know more than most, but you know all of the people. And this is another reason why at the end we'll talk about why people need to come to your show. Those that are interested in resource stocks, it's imperative that you get information from people like yourself and the people that are exhibiting at your conference so that you don't get led astray. You can see how important that is in the comments that you've made. I respect that a lot. Our last couple questions, Rick. Let's shift to silver. What does not the investor Rick Rule see in silver, but how about the speculator Rick Rule? Because I personally feel from an asymmetrical standpoint, the speculation of going long silver is as good as it gets. Low downside, high upside. How about you?
I would agree with that, with the caveat that I've studied the silver market for 50 years and I still don't understand it. In oil and gas, I understand the why. And in silver, I don't. But that's okay, because I have a very good memory. And we described earlier the anatomy of a precious metals bull market. The leadership in a precious metals bull market is always gold. But when gold's momentum attracts the generalist investor, and the generalist investor comes down into the precious metal space, perhaps it's because of the lower unit cost of silver. Perhaps it's because of its reputation for upside volatility. Perhaps it's both. But at some point in time, leadership changes from gold to silver. When that happens, you will not need Rick Rule to tell you it's occurring. It will be dramatically obvious. And silver moves much further and much faster than gold does. I don't own silver in an investment portfolio. But I do own silver in my speculative portfolios, and I do it because of history. When I look back to the decade of the 1970s, silver moved from $1.30 to $50. But some of the silver stocks did even better. My reference stock was Coeur d'Alene, which moved from 10 cents to $65. Not a typo. Now, I was too young and dumb and poor to take advantage of that, but you better believe it got my attention. Early in the 1990s, we had a wonderful metals bull market that many people, well, people younger than me didn't experience, but others don't remember. And silver moved from about $4 an ounce again to $50 an ounce. Now, I was by then ready to take advantage. And we helped establish two silver mining companies then, Silver Standard Resources and Pan American Silver. One started at 50 cents, the other started at 72 cents. Both peaked 6 years later at $45. And it's odd having experienced that, and then having experienced, of course, that wonderful bull market from 2000 to 2011. It's no surprise that I'm attracted to the silver and silver equities market. Make no mistake, most of my bullion, 95% of my bullion, is gold. Because I own bullion to sleep nights and stay calm. I own it for insurance. But I do have a physical silver component in my portfolio, some of which I forgot to sell from last bull market. And I have a reasonable position in the silver stocks. I don't know when market leadership is going to change from gold to silver. What I do know is, quoting our mutual friend Doug Casey, when the generalist investor comes down into the silver equities, there are so few of them, and their combined market cap is so minuscule that the money coming into the silo results in a circumstance like trying to siphon Hoover Dam through a garden hose. There is just not enough market cap in the space to handle the money that comes in.
Well, that was a question I was going to ask you. You know, there's so many gold stocks. Why is there such a small number of silver stocks? And I know many of the best ones and their staff will be at your show. The guys like Keith Neumeyer and Sean Kuhn and all the guys that have been serially successful. But why are there only just a handful of silver stocks and way more gold stocks?
Well, for one reason, economic silver deposits are few and far between. Silver mines comprise about 18% of primary silver supply. The rest comes from recycling and byproduct production from other metals. So it's damned hard to build a silver company. The second is the perception of political risk. If you're going to be in the silver mining business and be successful, you are going to be in Peru, or you're going to be in Mexico, or you're going to be in the far east of Russia, mostly. And those are not easy jurisdictions. There are some contrary examples, but particularly during periods of time with political instability in Peru and Mexico, which is most of the time, raising capital is constrained. There are silver deposits in other parts of the world, but on a project basis, it's very difficult, with a couple of exceptions, for those deposits to compete with Peru, Mexico, and the far east of Russia. Over the course of a decade, one might experience 2 or 3 extraordinarily good years in the silver business. I mean, extraordinarily good years, ripping years. But then one often suffers through 6 or 7 or 8 years that are lackluster at best. If you are a company executive and you're forced to raise equity to keep your company alive during those bad years, particularly in the not unlikely event that something is going wrong in Peru and Mexico, you have an interesting challenge.
Yeah, I would say so. And again, eloquence in the way that you express yourself makes such clear sense. Last question for you, buddy. I steal a lot of your one-liners. I always give you credit for it. This one might be my favorite, and I'd like you to put it in context. You have often said that either you're a contrarian or you'll be a victim. How true is that statement in today's market, and is the contrarian path still the one worth walking at this point?
Andy, you and I look at the fact that the gold market over 25 years has gone from $250 an ounce to $3,300 an ounce.
Yeah.
And the people that you and I talk to get the gold thesis. But you and I are like evangelist preachers talking to the choir.
Yeah. It's true.
If you look out past where we are, 0.5% of total savings and investment assets in the United States is denominated in gold and silver. This is silly.
Yeah.
This is
I steal that
absolutely
from you too, by the way, all the time, and always give you credit.
This is truly silly. And because I operate in capital-intensive cyclical businesses rather than sensible businesses, I absolutely have to be a contrarian. I have to buy when things are deeply out of favor. I learned something, though, from our mutual friend, Steve Sugarrood. Steve Sugarrood said, Rick, you're partly wrong. If you're as early as you often are at an 8% discount, you're partly wrong. You have to find something that is out of favor, unknown, cheap, and in an uptrend.
Well, that doesn't sound very easy.
That is a really interesting discussion when you overlay that on the gold market. I was saying the same things I'm saying today in 2021 and 2022, but I didn't get any particular joy, at least in the gold stocks, until 2024. What has changed over time is that my thesis has begun to be proven. The stuff is still cheap, but it's in an uptrend. You obviate now the time value of money objection to the thesis. And I think that's important.
Yeah, of course it is. But, I think that's the challenge, one that you've seemed to have done pretty well at. And I know many of the people who have followed your investment advice have done very well also, which leads me to, wrapping this up. And again, I want to thank you so much for coming here and speaking with me today. It's a joy. I always love listening to you. I just typically chuckle when the things that you say, which are so logical in the way that you say it, are so different than most people. You're master of the English language. Your mastering of it is insane. So kudos to you on that. You have a conference that I've been going to since it was the Agora conference up in Vancouver. In fact, there are only two conferences that I'm sure to never miss. One is Jay Martin's, the VRIC, where I last saw you. And the other is yours. And it's even here in my backyard in Boca this coming July. As we wrap up, I could cite the virtues, but I think it would be more appropriate for you to share with our listeners what makes your conference such a can't miss experience. And as someone who has been there since day one, it is a can't miss experience and should be, whether people can come and attend in person or watch it simulcast on live stream. Tell me a little bit about that as we wrap up.
Well, the first virtue is that the conference has gone on for 30 years, interrupted only for 1 year during COVID. What that means is that we've made the conference a little bit better every year. If you assume that somebody started a conference 5 years ago and theirs has become a little bit better every year, and we've been doing it for 30 years, it will tell you something about the qualitative difference between the two conferences. The consequence of a 30-year history is that we have a core of attendees, 200, 250 strong, that come to every conference. This is a knowledgeable, battle-tested, rich, smart constituency. The idea that all of the knowledge in the room should emanate to the dais, from the dais out to the masses, is stupid. We have the best group of attendees at any investment conference in the world because we've taken 30 years to build a franchise. That's the first thing. The second is that our selection of macro speakers, the big picture thinkers, is different. We don't want journalists. We don't want influencers per se. We want people speaking about macro from the belly of the beast, people who have participated in the institutions they discuss. David Stockman, this year's keynote political speaker, will talk about the U.S. budget and its impact on your portfolio. He will speak from the belly of the beast. He was the director of the Office of Management and Budget under Ronald Reagan, and in fact wrote a book about the process called The Triumph of Politics, which details, the derailment of the Reagan Revolution by Democrats and Republicans. And he talks about the prospects for the Department of Government Efficiency. He does it from the belly of the beast. He's not a failed journalist. He was there. He did it. We move on to Nomi Prinz. She'll be talking about Wall Street. How would she know? Well, she was a partner at Goldman Sachs. Again, from the belly of the beast. Then Daniela DiMartino Booth, talking about the Fed in particular. How would she know? Well, she was a researcher at the Dallas Fed. Again, she's speaking from the belly of the beast. She was a player. James Rickards, talking about the corrupt intersection between Wall Street and Washington. How might he know? General Counsel for Long-Term Capital Management, whose bankruptcy almost brought down Wall Street. We move on from there, having taught you the way the world is, as opposed to the way that the big thinkers wish it was, to how to make money. And in doing that, we have portfolio managers and investors who've managed billions of dollars successfully in natural resources for 40 years. Not analysts from second-rate brokerage firms who failed at crypto and failed at marijuana, failed in some other sector, but rather people who've been successful where the rubber meets the road in resources for a very long time. We move on from there to the living legends. The Ross Beatties, the Robert Friedlands, the Lundin family, people who have built multi-billion-dollar mining and oil and gas companies from scratch, telling you how they did it, and importantly, telling you how to identify the 10 million or 25 million market cap that's going to become a $5 billion market cap. Another thing that's really important, Andy, as you've said, every exhibitor at my show has been vetted. If you're going to be a bullion dealer or a coin dealer, I have to have watched you for more than a decade. I have to have watched you interact with customers we shared, and I have to get compliments, not complaints. If you are a public company exhibitor, you have to be owned in portfolios owned and managed by the conference sponsor. You've known me for a long time. There's no guarantee that because I own a stock, it goes up. But there's no other investment conference in the world that vets every single exhibitor. We turn down more exhibitors than we accept. And that allows me to make the most extravagant claim of any conference that I know of. Whether you attend live or live stream, if you don't think that you got your money's worth, I'll give you your money back. There's a money back guarantee. We do this because we interview every single exhibitor publicly before they come to the conference. You can watch these interviews and determine how to use your time better at the conference. After the conference is over, you have access to the recordings of the conference for a year. You're going to need it because we're going to give you 50 hours of programming, more than you can absorb. You're going to have to play the tapes. And we maintain discussion groups at the Rule Classroom about the conference so that you can compare your notes with the notes taken by other investors. All of that, top quality speakers, top quality analysts, top quality entrepreneurs, top quality exhibitors, allows me to say, satisfaction guaranteed or your money cheerfully refunded. There is no financial risk to you attending the conference.
Yeah, I agree with everything you've said. It's all true, everybody. It is true. I've witnessed it firsthand for a very long time. I'm honored to be there. I wouldn't miss it. I look forward to seeing you in person. It's much easier for me to go to Boca, which is about a 10-minute car drive, than it is to fly to Vancouver, which is a whole day experience. But I wouldn't miss it there either. Rick, you're a legend in every way. You're a good person, more importantly, and I thank you for all the years, and I thank you for coming on today, and I look forward to learning from you for years to come. What's the best way for people to continue to follow what you're doing independent of coming to the conference? How can people, I mean, heck, you just type in your name, you're everywhere, but other than that, what is the best way for people to follow you?
Yeah, I would say the best point of contact is Rule Investment Media. If you're a natural resource stock investor, go to ruleinvestmentmedia.com, list your natural resource stocks, and I will personally rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. This is a completely free service, so of course, money back guarantee.
And you want to people to send you all their marijuana and crypto stocks as well, right?
Yeah, please, nothing but natural resource stocks. No tech stocks.
I
no
heard you
private
say
stocks.
that a few times. I just had to throw that in and chuckle
You
a
know,
little
Andy,
bit.
the last due diligence I did in the marijuana business was over 50 years ago, so I'm not qualified there.
I understand. I get where you're coming from, Rick. Again, I can't thank you enough, man. I look forward to seeing you soon, and you stay well. And again, all the best to you. Thanks.
Great. Thank you, Andy.
Little by Little with Andy Schectman.